Good afternoon. My name is Haram Lim from Yonhap Infomex, and today we have two guests from JPMorgan. Let me briefly introduce these guests to you beforehand. First of all, Mr. Sudhanshu Sanadhya, Managing Director specializing in emerging markets, currency, and trading, and Mr. Sin Ben Ong, Executive Director at JPMorgan, also specializing in economic research. First, thank you so much for your time today. I really appreciate it. And I'm looking very forward to our discussion today. And as you know, we've exchanged several questions beforehand. So I think I am going to start by asking the first question about markets. So recently, as you all know, the US Treasury bond is skyrocketing. At yesterday's market, the 10-year UST rates went up above 1.67%. So basically, a lot of people think that this is mainly related to inflation worries and Fed's monetary normalization. So I would like to ask, how do you evaluate such recent movements of the US Treasury, especially in regards to inflationary worries?
First, thank you very much for having us in this forum. Mm-hmm. On inflation, if you specifically look at US inflation and the global inflation, the momentum in the recent time has been up. And there are a few drivers for it. The first one is that we saw, because of COVID situation in 2020, the demand got crashed for a couple of quarters. So one is the payback of that demand. Second is that during that period, the investment by corporates was also not there. So when the demand comes back online, we have two problems. One, we have a logistics problem, and also we see in the West that labor shortage is there. People are still not willing or unable to come to the labor market. So this has led to, one, rising commodity prices, two, rising logistic prices. So if you see, freight charges out of China have gone multiples of what they are a year back. So the real question is that, is this sustainable, and how the inflation dynamics are gonna evolve over the coming period? So we think that coming 2022, inflation should taper off. So people are worried about skyrocketing inflation. Yes, the short-term momentum looks very strong because it is coming from a low base. But if you look, the way I would propose is that please don't look at a year over year. You look from a 2019 exit during normal times and annualize the number. So you will see that the number which look really alarming over a year ago are not so alarming. But there are 2 points I would like to make here. One, is inflation going to be sticky in the sense that number is going to be high? Yes, it's going to be. But is it going to be as high as what we have seen in the recent times? I don't think so. Will it taper off? Yes, it will. Once we see normalization in the logistics, corporate capex coming back online, and people joining the labor forces. Now, going back to US Treasury, so people have suddenly been really alarmed by a sudden rise in yields in the last 10 days or so. But to put things in perspective, they're still not as high as they were at the start of the year. So our own forecast, I think, is about 1.75 to 2% on the 10-year US Treasury. From my trading perspective, our view is that it is going to overshoot rather than be benign. From a vol perspective, if you look, the bond market volatility is actually quite high as compared to historically, you look at even equity. So I think people are playing for a reflation trade. So you see US Treasury is going up, but equity markets are holding well. Currencies are holding well. And so it looks that inflation is there. The real question to ask is it going to be sustainable higher than what it was in 2019? And lastly, what the reaction function of the Fed is going to be. Now, Fed is clearly more dovish than the market. And because they have seen or taken the labor market also into their objective function. And things really are not really normal as of now. So it's going to evolve, but we do think rates are going higher. And inflation will print higher before it comes off in 2022. Beng can add if he has other thoughts on this.
Yeah, no, I think just to echo what Sudhanshu said, I mean, the general narrative that we have in JPMorgan is that core inflation or core PC deflator, which is the Fed's favored metric of inflation, is going to reach about 3.9 by end of the year and down to 2.3 in 4Q22. And as you can see, I mean, this is effectively, almost a normal reversion back to normal. And I mean, this is where we think of it as a transitory impact on inflation. Now, the issue here is that we effectively assume that the labor markets will normalize, and this is a key assumption because, as Sudhanshu mentioned, there are some special, I would say, circumstances that have actually led to some of this tightness. And one of the surprises we've had so far is that despite what has been the ending of these so-called unemployment benefits, the participation rate remains relatively low. What that means is that, as mentioned earlier, you have this recovery in activity, you have recovery in services, you have recovery in goods demand, but you've not had a commensurate recovery in the supply side of labor, which means people are not willing to work. And if that continues, this really, I think, does create a bit of a fly in the ointment of the Fed's reaction function, because the Fed effectively assumes that they'll reach some kind of normalization. Now, if the participation rate does not improve significantly, it does mean that wage inflation could actually come in a bit hotter than we were expecting. So given this narrative of inflation, picking up and full employment getting reached sometime in late 2022, 2023, we have the Fed moving in the early part of 2023. Now, if the participation remains quite low and wage inflation remains quite strong, the risk is that we could actually bring that forward. And that's something that I don't think has been anticipated, at least within our macro team, but it's certainly a risk. The other dynamic is, what is the relationship between inflation and full employment? Again, this is something that is very difficult to measure. We'll know once we get there. And the question is, do we get there in a hurry or do we get there at a leisurely pace? I would say the risk right now is that we're not effectively looking at a particularly rapid increase in that underlying inflation, if you will. And I think that is something we need to be mindful of at least the next 6 months.
Thank you very much for your response. You guys both mentioned Fed, and I would like to address the issue of Fed right now. And as we all know, well, you mentioned Fed is being a little bit more dovish than originally expected, but however, the tightening out process is going through. And as an emerging market, there can be many worries regarding to this, especially when we consider capital inflow and outflow. If the Fed is going to normalize its policy, like there are concerns that these emerging countries, some of the emerging countries might not be able to hold this. So as an EM market experts, what do you think is the implications of Fed's movements, and how can this affect countries, emerging countries such as Korea?
I think Fed liftoff, as we call it, worries everybody because we really are colored by what we saw almost about a decade back when the last taper happened. So, but let's look at a few things before we come to Asia and impact on Asian bond markets and FX markets and stock markets. So first, even if Fed tapers, we are talking about slowing down of injecting liquidity into the US system. So the stock of money is still going up, one. We see Fed not hiking till late 22 or 23. And you can see that as the market is also pricing there, the curve has become steep, but market also thinks that the first hikes would not be soon enough, but then there'll be subsequently many hikes. So clearly Fed is looking to take or reduce the liquidity injection into the system and then go for hikes. Now, if you look at the central banks in emerging markets, besides the monetary policy, stabilization of the market is also a priority, especially FX. So whereas we see Fed is talking about reducing the accommodation, we see that's many of the central banks in EM have actually embarked upon normalization of the monetary policy. So like in Asia, if you see, China was hit by the pandemic first, the East first, and the tightened conditions subsequently the first. Korea is also hawkish. And recently, MAS has also turned hawkish. And we think that other central banks will also follow. Now, Asia being ahead of the curve. Now, we see Brazil, Mexico, Russia also tightening, but their policy rates as of now were very, very accommodative as to the historical perspective take. So there is still a lot of, so one, the central banks are hawkish, they're hiking rates, plus there is a lot of hikes built into the curve. Now, do we see a mishap happening in EM? Extremely unlikely, given that central banks are so vigilant and they are proactively looking at the situation. So I don't think that is going to happen. But if Fed is hiking rates, it's very difficult, prima facie, for people to go long FX at the start. So they will stay away, but the dynamics in Asia are quite different. So if you look at the case of Korea also, or any other central bank in Asia, their reserve balance position is very, very robust. Mm-hmm. And in some countries, the trade balance is again very robust, which is balanced out by capital outflows in terms of investment, which in the medium term is not such a bad thing. So this is going to continue. The point I'm trying to make is that that it is very well within to say that central banks can control this, even if there is a policy mishap somewhere. They are very well positioned for us. Does it mean that we go long bonds at this moment? It looks unlikely, because going back to the first question which you asked, there are still many things which we are looking at, which we are evolving over a period of time. So we have to be mindful of that. But I would particularly not be very underweight Asian EMFX. So we can discuss this with Beng. He has some forecast as to where we see the broad dollar against the G10 currencies and against EM currencies. If you look at the EM, at least the Asia EM, forecasts are very, very benign. To you, Beng.
Great, thanks, Sudhanshu. I mean, I would say that, if you look at the general narrative in the last 20 years, I mean, we've had a period where the Fed was hiking consistently from 2000 to 2008. And in fact, the dollar's weakening over that period. And what was the key difference then versus what happened more recently was the fact that growth was actually quite strong. So in other words, what you have is that you had a very powerful growth tailwind that effectively offset the tightening impact of higher Fed funds rate. Now, even though we have had fairly strong external demand, we do expect over the next 6 to 12 months to see domestic demand pick up. And that in itself, and again, this is a huge debate we have, is whether that is a sufficient condition for capital inflows to return to Asia and therefore support the currencies. So I think I would say, this is something that we're watching. But if we are right that growth does pick up, it should actually provide a nice buffer against tighter US conditions. But again, this is going to be quite different from what we've seen in the past, because in the past, we've usually seen exports lead the charge, followed by domestic demand. This time, we've already had the export strength. Domestic demand hasn't quite recovered yet because of the COVID-19 lockdowns. And as much as those lockdowns start easing over the next 6 to 12 months, this should then effectively allow that transmission, if you will, to domestic demand. And this is where I think, we make a distinction, because as domestic demand starts recovering, we will see core inflation start picking up. And this is where central banks will start effectively responding. As Sudhanshu said, we've already seen some central banks act. We expect to see more next year. And the question is that a sufficient condition for capital flows to return, as I mentioned earlier, and therefore support the currencies? And this is a very unusual cycle, which makes us actually without precedent. But hopefully, if we are right, the capital flows should be sympathetic to the growth and therefore provide a buffer against a much weaker, or in fact, dollar strength, at least within EM Asia. The second point I want to make is that one of the things we've noticed is that there's a significant, I would say, sympathy or correlation between Asian FX versus what's happening in the CNY. And in as much as the CNY remains roughly stable, this should actually provide a fairly nice, I would say, support for the rest of the region as well. Thank you.
Thank you for your response. I'm kind of relieved to hear that Asian markets will have a buffer in the tightening off process. And you briefly mentioned this before, but I just want to ask you specifically, when do you forecast Fed to raise rates? Because a lot of experts say the tapering process will start in November. And you briefly mentioned about 2023 about rate hike. So can you elaborate on that issue a little bit?
So the view again is that we have a Federal Reserve that's going to be very focused on full employment or the labor markets, and we don't expect full employment to effectively return until maybe late 2022, 2023. And this effectively, calibrates the timing of when we expect the first Fed hike, which is in early 2023. As I mentioned before, there are potentially some risks to that, which is that the participation rates may not go up very quickly. And this means that the wage pressures could actually come in faster than we think. So that's a risk that we're certainly mindful of. But if we just observe the general narrative and discussions from the Federal Reserve, the labor market is absolutely key. And if they are right, we will not see full employment until late 2022, 23, and therefore first hike in early 23.
Well, thank you very much. I think I will turn the attention to markets. So we only have like 3 months this year, but what is your general forecast of global FX, bond, and equity markets for the remaining time of this year and perhaps next year?
Okay, I can just talk about that quickly. So for the Fed's reaction function, we have the Fed first move, in terms of the Fed funds rate in early 2023, and we have a 10-year US Treasury forecast of 175 by year end and 2% by middle of 2022. And with that, we have the dollar index slightly higher. We have it roughly about 121 currently, and it goes to about 123 by mid-year, and a euro dollar forecast at 112 in mid-year, from roughly about 116 odd currently, and dollar CNY at 650, and dollar Korea by about 1,200 by mid-year as well.
Yes. So as I mentioned earlier, if you look the dollar forecast versus the G10 majors and EM Asia is very, very benign. To say that dollar China at 6.5, when you're talking about 1 or 2% in a currency, it's quite less. So very clearly, towards the end of the year, general risk appetite also goes down. And second is, given the uncertainty in US, there are headwinds against EM Asia or EM general appreciation. So it's because of that, I don't think people will come and pull money out of Asia. It's just that we will not see money coming into Asia. Therefore, it is a slight, I would say, benign kind of a middle of the range. There is no real compelling trade. People would like to be long dollars because it's a US economy which is doing the best in most of the major economies. Of late, we have started talking about a slowdown in China, which again, for the regional trading partners, is not a very good news. But we still have to see, because these things are all evolving, and some of the things which are happening in China are of their own design. It is not that those were accidents. They knew fully well what they're doing. So I think they have a policy wherewithal to manage that also. So I would not be very bearish. Am I bullish? Not really, because the focus right now is more on the equity markets, unfortunately. So on the stock market, if you see, the US market again has been the best performing, and very clearly so, because the bulk of the heavy lifting was done by the Fed in terms of QE. The bounce back in earnings has also been very, very robust. We estimate that the S&P earnings for the year should be around 200 to 210, which is a nice lift from an average, historical average. So it ends up at maybe like between 4,500 to 5,000. So as long as that story is intact, we don't really see a big risk. And then coming back to the Asian markets, as Beng was saying, that most of the trade has been protected, but like the trade balances are record highs for most of the countries. But the domestic economy in many places have not really opened up. China has opened up. India, to a certain extent, is opening up. If you look at the global mobility, it's still not where it was at exit of 2019. So as we will see demand going up. Now, in US, there's a very interesting point I would like to make here, which again brings a bit of question into a secular dollar strength. There's something to be mindful of. Does it play out that way? I don't really know, but we definitely need to look at it. And that is the US savings, domestic savings are very, very high. Corporate savings and earnings are also very high. Once people get back into the labor market, the propensity to spend would also be higher, which to me looks at the US trade balance would deteriorate with the rest of the world even further. So then we are left with capital flows, which you are also discussing. Now, capital flows could be in the bond market. I don't think that is happening anytime soon. This is not to say whether the market is fairly priced or not. It is just to say that the international investors are still not, convinced that things are cheap and they want to come in. But equity markets would be something to watch out for, specifically if you look at Korea also, a very large trade surplus, but you have a lot of capital outflow in terms of investment abroad in financial instruments, which is institutional and off late retail also. And these numbers are very large. We are talking about $20-30 billion. So they on the margin would decide where the currencies go. Is that such a bad thing? I don't think so, because you are moving your external balances from a central bank, which holds the reserves, into the private domain when you invest abroad. In the medium term, it is okay, but these numbers are going to be large enough to drive the FX in the short term.
So basically, I think all the FX and equity and bond markets going to be correlated eventually. And my next question is about China. You mentioned how Asian assets are being more correlated to China's asset. And on your presentation material, I saw the word CNY block. And Mr. Ong, you also mentioned this before. So can you explain on this issue a little bit?
Great. Thank you very much for that question. So this really pertains to the exchange rate regime that we're seeing across Asia. And I think what we've noticed in the last 5 years is there's been a notable convergence in nominal effective exchange rates across the region centered on China. And this really started, I would say, in 2015, late 2015, when China's FX management moved to a trade-weighted basket of currencies from a bilateral trade weight against, a bilateral exchange rate against the US. And so what we've noticed is that because of the regime change, we've also seen that convergence occur, partly because of that regime change. And this is also feeding into the, I would say, regional policymakers' preference for, targeting nominal effective exchange rates rather than bilateral exchange rates versus the dollar. And so what this has also done, together with China's move and very high and still rising regional trade exposures to each other because of rising regional trade.
Thank you very much for your insightful response. And we are already running out of time. So I think we will have to wrap up here. But if you have some additional remarks or points you would like to address, please feel free to add on.
We can discuss markets till evening. So I think it's time we stop now. Okay. Thank you very much for having us here.
Great.
Thank you so much for your wonderful interview. And here I would conclude this interview. Thank you so much.
Have a great day. Thank you.
Thank you.
Thank you.